Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's market action because you can see stocks really holding on to those gains after the December job report showed a slowdown in wage gains, and that seems to be all the market cares about right now. You're looking at the Dow up 727 points right at the highs of the session. S&P up nearly 2.5%. You're looking at the Nasdaq 100 up nearly 3% today, so huge gains for the three major averages. Taking a look at the action in the bond market, you're seeing yields pull back quite a bit, off just about 15 basis points for the 10-year yield. 30-year yield also moving to the downside here, off about 11 basis points. The U.S. dollar pulling back, lowest level that we've seen in about 3 weeks here for the U.S. dollar. Taking a look at the sector action today, certainly a lot of buying. All 11 of the S&P sectors moving to the upside on an intraday basis. You're looking at materials, technology, and consumer staples there among the biggest gainers this afternoon on a 5-day basis. So what we've seen play out this week, healthcare, the only sector in the red so far during the new year. Communication services and financials, though, holding on to gains. I mentioned some of the buying action that we're seeing. Let's take a look at the Nasdaq. Some of the largest technology players here, really among the leaders in today's action. You're looking at Apple and Amazon, both those names up well over 3%. Apple up nearly 4% today. And taking a look at some of the bank stocks here, again, green across the board. JP Morgan, Wells Fargo, Bank of America, Morgan Stanley there, Dave, among the outperformers, all because of that wage gain number. The market's really looking for anything that they can really hold on to for some optimism.
Hey, man, we've been looking for some good news. We've been desperate for it. It was a glimmer, and I guess we'll take it. Interesting market reaction. Let's get you up to speed now on that jobs number. You may hear nothing but gloom and doom, but consider this, friends. We've just finished the second best year for jobs since 1939. Savor that for a minute. 223,000 jobs created in the month of December, moving the unemployment rate down to 3.5%. Markets rising primarily on the slower pace of wage growth. Average hourly earnings increased 0.3% over the previous month and 4.6% annually. That's compared with 0.4 and 4.8 in November. And that primarily is why we are ending the week on a very, very high note. Just stepping back, though, it is remarkable, the second best jobs performance since the 30s this year. And all you hear out there is how this economy is in such rough shape.
Yeah, I mean, the jobs picture really holding up here, and it has been resilient. That has certainly been the theme that we have been talking about this year. And even looking at today's gains, the gains holding on despite some of that hawkish rhetoric that we continue to get from Fed officials. A number of Fed officials speaking out today, Raphael Bostic being one of them, saying that he still favors rates above 5%, holding it into 2024. Fed Governor Lisa Cook saying that inflation, while it does seem to be easing, still remains way too high for the Fed. But again, markets shrugging off all of that hawkish rhetoric, at least for today. And we're looking at gains, significant gains, I might add, across the board. Let's talk.
They just don't believe. They don't believe the Fed.
They don't want to.
I think we're looking at 50. I really genuinely do think we're looking at another. The Fed has been very clear. Tighter, longer, all the way through 23. I will say one more note. The labor participation rate ticking up. Hey, we'll take it, man. That was some good news. Still a percentage point below pre-pandemic levels, but a tick up. Good news indeed.
Yeah, certainly more people returning to the workforce. All right, well, let's dive in on what this means for the market, the economy. We have two experts here. We have Joe Brusuelas, RSM Chief Economist. We also have Keith Lerner, Truist Chief Market Strategist. Great to see you both. Joe, let me start with you. So some improvement, it looks like. Wages really the headline in this report. What do you make of it?
All right, let's hang a hat on it. The 3-month average annualized pace slowed to 4.3%. If the underlying pace of inflation is at 4%, it means in the next 3 to 6 months, we'll see wage growth slow beneath that. That's when you start talking about, well, it's not just time to pause, it's time to consider when that first eventual rate cut's going to happen. Well, I'm in the camp, it's not till next year, and actually I think they ought to hike 50 basis points at the end of the month. I really do. Let's get to that range between 5 and 5.25% and then stop. Right. And let's let the lagged impact of all those rate hikes work its way through the economy. But if you're smart money, you're actually already in the market. You probably started to move in the middle of last year, and you're going to begin increasing your positions in anticipation of the pause and then the rate cuts next year.
Keith, your turn. Tagging you in. Your read on today and that point of view from Joe.
Yeah, well, first, great to be with you on this Friday. Happy New Year to you all. Listen, I think today's report was solid. It was somewhat Goldilocks, and you had a market that was, of course, caught offside somewhere. You look at some of the sentiment numbers that came in yesterday, about 20% bulls. And towards the end of last December, or since the second half of December, we saw really heavy selling in funds, and we think part of that was tax loss selling. So some of that subsiding also helping as well. So yes, we think that we have a little bit of a rally here, some good news. It likely has further to go, but our point of view is you have to be more tactical this year. We're still somewhat more defensive, and right now, given current estimates, and let's just say those earning estimates stay where they are. You're trading at about a 17 times earnings today. Let's just say you go to 18, which is towards the top end of the pre-pandemic range. That brings you to 4,100. We think that's towards the top of the range, so we would use strength towards that area to actually reduce risk for the overall market, because we still think that all these Fed rate hikes that are in the pipeline are going to weigh on the economy. And the last point I'll make is we kind of think this is somewhat of a reverse Tepper trade, is what we've talked about recently, which means back, last decade, David Tepper, the big hedge fund manager, said either the economy is going to get better and that's going to support the market, or the Fed's going to support the market. Today, we have almost the reverse of that, in that the economy is going to slow down, and that's going to hurt corporate profits, or it's going to stay strong and the Fed's going to continue to weigh against it.
Joe, when the Fed is looking at this report, though, certainly we have seen wage growth begin to cool, but that unemployment rate falling to 3.5%. To what extent does that kind of complicate the picture and complicate the Fed's approach to this, just in terms of determining the current state of the economy right now?
Well, that's what's going to hold the Fed back, because it's the household survey where they derive the unemployment rate from. 630,000 people actually exited the workforce, according to that survey. That's why the unemployment rate dropped from 3.7 to 3.5. If you remember, Jay Powell basically said, look, he does not think all those 55 years older and older people who've left are really going to come back. And for the first time, the Fed actually said, and I thought this was really interesting, 550,000 prime-age people were hit by COVID. They're not coming back either. That means the Fed's made an a priori decision that this labor market's going to remain tight for the remainder of this cycle, likely through whatever slowdown or recession we have, and then into the next business cycle. This just isn't going to look like all the recessions in your models that you've put together since the end of the Cold War or before.
Yeah, this may be peak labor force participation. It seemed like those workers are gone. So, Keith, how much more work does the Fed have to do? And because of that, what do you make of the bond market moving ahead?
Well, we are positive on the bond market. We actually increased our allocation late last year. We think bonds are back. Obviously, we're having a good day today. And, we still think, even with this number, and maybe it's more of a second half type of thing, we still think recession risk is relatively high. So we like, high quality fixed income, keeping it simple. We think there's value in the short end, but also you want to kind of barbell that with longer term, high quality government securities if that recession risk starts to build in. But I think what you're seeing today is maybe that pushed back a bit relative to expectations, and everyone, or the consensus, is pretty negative to start the year. So I think that's helping the market today.
Joe, you also mentioned that risk of recession. Do you think that's a sure thing at this point, or could we still potentially avoid one and get that soft landing?
Okay, so it's not a sure thing. I've attached a 65% probability, so I'm in that camp. But when I see sort of the Congress at the end of the year put an additional $45 billion in defense spending on the table, well, that's going to help offset some of the hole that's going to be blown in private sector investment once we see the economy decelerate, right? So, it's going to be a very close call. I'm not expecting a recession that resembles anything like we've gone through in the past 30 years. It's more like going to be like what we saw in the early 1990s and again at the turn of the century. Shallow, short, not much of a duration, but we're going to call it a recession because the unemployment rate's likely to move up towards 5% by the end of next year.
Yeah, we've heard Mark Zandi refer to it as a slow session.
Slow session,
that he thinks.
Mark's very creative in that way.
That sounds about right. Is that how you see it, Keith? And I just want to clarify. Earlier you said if earnings stay as is. Do you think we're looking at further downgrades to earnings ahead?
I do, and that's why the point was, hey, even if we take earning estimates to consensus today and just say they stay where they are at 230 on the S&P, today they're trading at 17 times, and if you go to 18 times, that brings you to a little bit above 4,100. We think there's downside to those earnings as the economy slows later in the year. And then more specific to the question about short and shallow, I think that makes sense because of the labor market, because consumer debt levels or service ratios are low. I would just caution, though, that I think the one thing that can make it different is an outlier event, because I think there's going to be more fiscal restraint and monetary restraint relative to the pandemic before, and because of the scar tissue the Fed has because of this inflation that we've seen in the last year. So I think, that's just something to keep in mind. Why could it be different than the short and shallow, which has kind of become more of a kind of general view?
What kind of outlier event?
Well, that's it. You don't know, and that's the thing about last year. That's the thing. Like last year, no one was predicting, Russian invasion of Ukraine. So when the economy is slowing down, you're just more susceptible to a deeper downturn. If that happens, you're not going to have the ammunition in our view relative to the past. Again, it's hard to invest on an outlier scenario, but I just think that's where something can go against the kind of short and shallow theory. But I think it makes sense from a base case standpoint because of the employment picture and the debt ratios that I mentioned.
Let me help my friend Keith out here. Clearly, the drama going on in D.C. is on everybody's mind.
Yeah.
Right? We hope that ends soon rather than later. It does appear, though, the likelihood of a debt ceiling debacle is increasing, probably around mid-year. And if you think about the last thing we need is stress at the short end of the Treasury market in T-bills and increase in credit default swaps on the United States, which would actually cause an increase or tightening of financial conditions, probably when the Fed's paused for the past few months or is about to pause. So the timing of that could be very problematic and is a risk nobody who works in financial markets, economics, or policy can ignore based on what we've seen the past 4 days.
You mean the debacle on the House floor, do you, Joe?
I'm not going to talk about it, Dave, but I just teed you up, my friend, and knocked that over the fence.
Oh, my goodness. We'll get to that later in the program. What a mess. Joe, good to see you, sir.
Good to see you guys.
Keith Lerner, also good to have you, sir, as well. Happy New Year to you both. Just getting started here on Yahoo Finance Live. Coming up, Vince McMahon returning to WWE. We'll take a look at what lies ahead for the media company. And it looks like the 13th time will not be the charm for the aforementioned Kevin McCarthy's disastrous bid to become House Speaker. We'll have the latest for you. And the International Space Station's chief scientist tells us why the space station is open for business. Don't go away. WWE shares surging today, up more than 19% as Vince McMahon makes his return to the company's board of directors. Now he plans to steer the ship toward a possible sale. Joining us now, Brendan Coffey, who's covering the story for Sportico. Brendan, good to see you. This playing out like your typical wrestling storyline, Vince busting back in. I'm not sure if he's, the villain or the hero this time, but we'll see in the weeks ahead. Just generally speaking, your reaction to the King's return.
Oh, well, it's dramatic for sure, befitting WWE, isn't it? Well, but ultimately not a surprise, right? It's the golden age of content rights, and Vince wants to make sure he and the WWE gets their share.
Brendan, taking a look at the potential outcome of this, if they do in fact are able to orchestrate a sale, who would be interested? Comcast, of course, has been floated, but many names have been floated as potential buyers. Who do you think is likely to be a buyer here?
Yeah, well, Comcast makes a lot of sense, right? Why, if you're gonna rent the content, why not just pay a little more and buy it? So that would include Fox, which has some rights as well. Beyond Comcast, which does seem to be a natural partner, you can't discount Amazon and Apple and the streaming, the money-rich streaming services too. They want content as well.
Yeah, those are the two with the huge amounts of cash. I know Disney has been thrown about, but certainly a little short on cash, and perhaps Endeavor. They've certainly been in that field. I was interested in this statement from Vince. The only way for WWE to fully capitalize on this opportunity is for me to return as executive chairman. I would imagine that ruffled a few feathers. 3 people out of the board as he comes back in with his hand-picked board members. Is there some dissent, do you sense, among the group? The company has gone incredibly well since he stepped aside.
Well, yeah, and 2 other board of directors members stepped down as well today. His return is actually is really good, because the scuttlebutt had been that WWE really is in a position to be sold, right? It's successful, but it's not too big that another bigger partner like a Disney or an Amazon could buy it. But the feeling had been is that he would be the obstacle to selling, right? Why would he want to sell? He built the business from the ground up. Why would he want to see it sold? And so him jumping back in and saying and really saying that he appears to be advocating for a sale is super bullish for a sale.
Why has WWE been so successful in recent times, in particular last year, outperforming just about every media asset on the planet?
Yeah, stock was up 40% last year. They're just hitting on all cylinders, and it translates really well internationally too. They're really making great inroads in India. You saw events in Saudi Arabia too. I think it's just that combo of they do a great job of making must-see event TV, which is really what drives viewers and sort of deliverables on the ad side of things. With a flair for the dramatic and sort of archetypes, villains and heroes that people around the world can easily identify with.
And Brendan, how do you think it stacks up to others out there? Because certainly other content creators, could they be able to match the popularity that the WWE certainly has now and the size of the WWE? You were just talking about the international appeal of it now too.
Yeah, well, what's comparable to WWE? You look at sports naturally. The sports leagues, which are the big 5 American sports leagues, will collect $15 billion in rights this year from media companies. And why is that? It's because they have compelling content that people want to watch live or close to live, and a lot of intellectual property, a lot of content. And WWE has been making a lot of strides towards kind of pulling things out of their library and trying to sort of create a stream of both live events, but also documentaries and things of that sort to really create a steady stream of content that really in this day and age, anyone who wants to or needs to fill 24 hours a day would find really attractive.
Well, certainly Wall Street is encouraged by this. Shares up 19% today. Brendan Coffey, great to have you. Thanks so much. Have a good weekend. All right, well, coming up, Kevin McCarthy still does not have the votes he needs. Stay tuned for the latest update on the House Speaker drama when we come back. We are looking at live pictures of the floor right now where the vote for House Speaker is still underway, now in its fourth day. This is the longest that this type of vote has gone on since 1860. Congressman Kevin McCarthy has now lost 13 bids, picking up, though, several key GOP holdouts earlier this afternoon. We want to bring in Rick Wilson. He's a co-founder of the Lincoln Project. Rick, it's great to see you here. So certainly has been a debacle here for the GOP over the last several days. McCarthy, though, gaining some momentum, to put a positive spin on this, picking up 15 of those holdouts. What do you think? Is he going to get enough?
You know, he's going to sell off every valuable asset of the speakership until he gets this sort of hollowed out husk of what the job used to be. What he's done is compromise with people who want to destroy the ability of the speaker to manage the House, to lead the House. They want to be able to disrupt any proceeding from the floor. They want to be able to remove the speaker at almost at whim. And so I think what's happened is, you know, he's going to get what he wishes for in the very end of this thing, but it's going to be such a compromising position that his term as speaker will be short and painful.
It is brutal to watch, unless you're watching C-SPAN, Rick, which has been killing it, up 150, 60%. In the end here, how does this damage the party, the brand?
Well, look, the brand has been fundamentally altered in the era in the post-Trump era. The brand has become less ideological and more performative. It's become about owning the libs. It's become about, you know, exercising the the entertainment complex of what the GOP used to be. It is no longer about limited government and fiscal restraint and government staying out of individual liberty. Now it's about this big culture war idea, and this, again, the idea that you have to, everything you do has to be this Fox-friendly performative show. And I think it really, the party's evolution into chaos, this isn't the last part of the dance, but this is, for the last 6 years, we've seen the party become increasingly disconnected from reality with QAnon and big lie election conspiracy theories and all these other things that have slowly led it to this place where we're at today. And look, even though people are trying to frame this as Kevin McCarthy is the normal guy, of the 200 members who support McCarthy, 143 of them are active election deniers at the minimum. And so, the craziness of the GOP has become more and more central to the brand as time has gone on.
So, Rick, when we talk about the future of the party, where do we go from here? Any odds that the GOP will be able to come together, get some sort of support over the next 2 years? Never mind bipartisan support, which we haven't even talked about yet.
I mean, look, I'm a center-right, fiscal and individual liberty conservative. I don't have a political party in this country I can go to right now. And I think there's going to be an increasing sort of gap in what the Republicans' legacy brand communicates to a lot of voters and what the current brand really is. And as that diverges, you can keep all the labeling and the branding, but it's not going to be the same thing. And I think you will find voters eventually starting to do what they did in 2020 and in 2022 that our group is very good at, the Lincoln Party is very good at, is splitting off those educated conservatives and upper income conservatives and saying, is this really you? Is this your thing? Do you really want to spend 2 years blowing up the economy by debt ceiling chicken? And do you want to spend 2 years investigating Hunter Biden's laptop? Or do you think the party should represent something different and better?
Yeah, I think
so. It's going to be a significant challenge to retain the more educated parts of the Republican cohort.
Yeah, I think this is what Mitch McConnell's been fearing and, in fact, warning of for years now. Rick, I can't help but wonder what this means when we go to 24 and in terms of a Republican nomination for presidential candidates. How does this play out on a grand stage when the party is going to pick its nominee?
Look, there is a lot of talk from a lot of ambitious people, from Ron DeSantis to Josh Hawley to Nikki Haley to Kristi Noem to Ted Cruz, that all these people think they are the next incarnation. They're missing the fact that even though he is a weakened figure in some ways, Donald Trump still has basically 100% name ID with the Republican Party. He's in the race. He's going to get in the race. These guys all have to get on a debate stage with him. And at the end of the day, even if he's holding 20% of the Republican vote, when he goes then to Iowa, New Hampshire, and South Carolina in 2023, 24, and these contests begin, he comes in with an extraordinary, pad of support. And so it's going to be very difficult to see how these other people crawl up that very slippery slope to chase after Trump, who has a lot of built-in advantages going in. It is still the Trump party. It is still going to be a party defined by his excesses and weirdnesses and everything else. And voters are going to have to make that decision once again in 24. Am I with the party of Trump or am I with the party of America?
Of course, it sure was interesting when he weighed in, tried to get the party to vote for McCarthy, and no one budged, not even Matt Gaetz. Between now and that nomination, can we just forget about any actually legislating by Congress in the next 2 years?
I would put a very low probability of Congress doing any kind of legislative action that isn't purely performative. For instance, they talk about going after big tech. They're not going to go after big tech. What they're going to do is hold a few stunt hearings and show trials, and then the lobbying crew for Facebook and Google and Microsoft and everyone else on K Street will write a bunch of checks and they'll shut up. You're not going to see things that are going to meaningfully improve the economy from any perspective. In fact, you're going to see them do things like play chicken with the debt ceiling that, as you know, are going to cause a lot of market uncertainty and a lot of difficulties in an economy that, while the fundamentals are good, there's still this weird perception that it's not. And that would probably plunge it into a situation where going into 24, you would have a very bad economy and the Republicans would have done nothing about it except for blow it up on the debt ceiling.
Would frustrate millions and millions of Americans. Rick Wilson, great to have you. Thanks so much.
Happy to be with you. Thanks.
Well, the Wall Street Journal reporting McDonald's is looking to make, quote, difficult decisions about its corporate staffing levels by April. In an interview with the Journal, McDonald's CEO Chris Kempczynski is saying that, quote, some jobs that are existing today are either going to get moved or those jobs may go away. McDonald's shares trading today in the final hour of trading, still holding on to gains up just about 3%. Well, coming up, Party City is reportedly preparing to file for bankruptcy, shares off 53%. We've got the details for you next. It's time for Triple Play. Three stocks that we're watching in the final 30 minutes of trading. Costco, Lululemon, Party City. Josh Schaefer on set here with us. Let's kick it off with Costco. It's a big winner today, a top trending ticker here at Yahoo Finance. The move higher, you're looking at gains of just about 7.5%. That's coming following strong holiday numbers. December total comp sales growth of 5.5%. That was better than what the street had anticipated. Net sales $23.8 billion. That's a 7% jump from where we were about a year ago. U.S. comp sales climbing 6.5%, nearly 6.5% from just a year ago. Now, Wall Street is looking at this as a positive sign for the retail sector. A number of analysts weighing in today. D.A. Davidson analyst Michael Baker writing in a note to clients that the results, quote, endorses the theory that holiday sales came late in 2022 after a slower start in November. Lots of questions about that slow start in November, whether or not that was going to linger for the rest of the holiday season. We're seeing the excitement reflected in today's stock when you take a look at Costco's gains of just about 7%. So it looks like maybe the holiday period was much more positive than maybe the street had initially anticipated.
Definitely, Shauna. And I think another interesting part of this Costco number two that Cowen was pointing out, Cowen has this, by the way, picked as their 2023, one of their top picks of the year. It was Yahoo Finance's Company of the Year in 2022. So maybe we were a year early or they're a year late.
We were ahead. Everyone just needs to keep watching us.
But they pointed out that food is once again outpacing non-food items, which I found interesting, and that inflation might be coming for those non-food items. So something to watch there in terms of, yes, we're talking about holiday sales right now, but is food still that driver for Costco when we talk about inflationary pressures coming in? Definitely something to watch. But speaking of holiday sales, a popular brand over the holidays, my play today is Lululemon. Shares up nearly 2%, with Wells Fargo upgrading the stock to overweight and slapping a $380 price target on the stock. Now, analyst Ike Borchow noting that Lulu's top-line resilience over the past few years has been, quote, nothing short of stunning. Wells Fargo also highlighting Lulu's resilience against softness in the space and strong full-price direct-to-consumer brand positioning as opposed to other brands which are currently navigating a shift from wholesale. Now, Wells Fargo also highlighted Nike, Burlington stores, and Ross stores in its high-quality basket for its overall 2023 outlook, Dave. And I think it's interesting when you sort of take a step back and look at what Wells Fargo is pointing out here, right? They're pointing out, well, the consumer might be trading down, but what does that mean? It might be going to a store like Ross stores for a discount, or a strong brand. When you talk about a D2C brand like Lulu, where they haven't seemed to lose anyone yet.
Nothing.
Because people are still buying that at full price, or you got to go all the way down and people are going to Ross stores and looking for a deal. Doesn't seem like there's much in the middle.
It is an emotional attachment to our Lulu, and that's why we wear it to work and to the gym
I'm
and
rocking
everything
them right
else.
now, Dave.
I'll tell you what really
wear 'em on a
surprised
daily
me.
basis.
What really surprised me also in that note was a downgrade within it of Ulta, another company that's been an absolute powerhouse through and out of the pandemic. And we thought there was no stopping them because they appear to be entirely recession-proof. But they downgrade Ulta and cut the price target from $450 to $400. Quote, tough setup given sales margin overshoot into the slowing macro. So I was a little bit surprised by that because they crushed it last year, up 20%. My play is Party City because it appears the party could be over. The stock slumping on news from the Wall Street Journal that the retailer is preparing to file for bankruptcy within weeks as a result of dwindling cash and lower sales resulting from higher inflation. Now, Party City has, according to the report, hired AlixPartners as a restructuring advisor and are in talks with bondholders about converting their debt. The company also has plans to shut down some of its 760 stores. This follows news in November that the company would lay off 19% of its workforce after disappointing Halloween sales, part of a $30 million cost-cutting project underway. The stock down more than 50% today, down 97% over the last 12 months. This breaks this parent's heart. I go to Party City often. You know what's underrated there?
What?
The plastic cups, which I have about 100 of in my house. You have them for a
Recent
party,
birthday
they stick
parties.
around for weeks, months.
You know, I'm a little bit surprised by this and the fact that Party City is in the position that it's in right now. Because if Party City, I'm just speaking straight as from a consumer perspective right now, if they were to go under and they, of course, were to file for bankruptcy, there's not a lot of options out there for retailers that are specifically focused on parties. Yes, you could get things here and there, say from Target, some of the other larger retailers, but this focus on parties, especially coming out of a pandemic, was a play that you thought would have performed much better, and people were placing much more of an emphasis on.
It'll be interesting to see what retailer does find opportunity there, right? Is it a Target? It won't be a Bed Bath & Beyond or something like that. I'm trying to think of other retailers, though, that you would go to for a large. Target, Walmart, I guess maybe Costco, right, has things like that you go to because you're going to buy the party.
Membership, though, yeah.
Right, but you have to go to buy the party food, I was thinking, so you're already there. But it's a good question.
The balloons.
The balloons. I guess it's just grocery stores now that you go to for that?
I don't know. I got to figure it out, though.
I think maybe one of the final nails was Spirit Halloween. They have 1,500 Halloween stores. That took away a key element from Party City, and they don't have year-round real estate. They just have pop-up real estate, so their costs are just so much lower. Josh Schaefer, good to have you, my friend. Coming up, the FDA giving early approval to a new Alzheimer's drug, sending shares of Biogen higher. We'll tell you about that next.
The FDA giving the green light for a new Alzheimer's treatment. For more, we want to bring in Yahoo Finance's Anjali Kamlani. And Anjali, we certainly saw some action in the market today on the heels of this news.
Absolutely. So this is something that we'd been anticipating, hoping would come through in terms of Biogen getting its second attempt to get an Alzheimer's treatment through the door. The FDA greenlighting it as part of a fast track approval. And that's something that has been a point of concern for some experts and and especially medical experts. So let's just recap what happened. We know that the fast track approval is basically for treatments that have unmet need but large population base, just like for Alzheimer's. Millions of individuals, more than 10 million at least, could benefit from this. It's catered towards individuals that have early, sort of milder disease and can qualify for milder treatment. It is a twice, every 2-week treatment and is going to cost about $26,500 a year. That is close to Biogen's other treatment, which initially hit the market at a whopping $56,000 a year. Lots of pushback on that, Medicare not covering it. So the price point, a concern. As you can see on your screen, this is who qualifies. We see, the focus of it. It is the second treatment, not just for Biogen, but also in this class of treatments, which is targeting the sticky plaque buildup known as amyloid beta in the brain. And so that is the reason why there is so much to do about this.
There's rarely good news on Alzheimer's, so let's just savor this for the moment. All right, China continuing to handle an explosion of COVID numbers and now in talks with Pfizer. What's the deal?
So China is in works to get a generic version of Paxlovid, the antiviral to treat COVID-19, on the market in China. They already just last week got a deal with Merck through Sinopharm, their local manufacturer, an exclusive deal to produce that. They already do have Pfizer's Paxlovid in the market, but because of the rise in cases, because of what China is dealing with right now, they're really struggling to meet the demand for treatment. Now, remember, this is a treatment that's given to early disease, early symptom onset, and for typically older individuals, which is a lot of what China is seeing when it comes to the spread of this variant. They are struggling with a black market right now. So we've got, India's Hetero with producing a generic version already backed by the World Health Organization, and that's already on the market, but it's not approved there. So it's a struggle right there right now for China to get some of these treatments.
But still not going anywhere near an mRNA vaccine.
No.
I mean, you just throw your hands up, right?
We could get into a whole, that's a
whole nother half hour
conversation, yeah.
Still remarkable, isn't it? Anj, good to see you. Have a good weekend. Thank you. All right, let's talk a little Tesla now. Shares actually rising today. 2.3%, which is really a surprise. No one expected that. The company continued slashing prices on several vehicle models in China. Reuters calculations indicate Tesla cut prices by 13.5% on its China Model 3 and 10% on its Model Y. This comes just days after Tesla missed estimates on fourth quarter vehicle deliveries and produced 34,000 more cars than it delivered during the quarter. Shares are off more than 40% on the month, Shauna. It continues to be a demand issue. Everyone for quite some time was saying it was strictly an Elon Musk distraction Twitter issue. Clearly that is not the case. There is at the heart of this a demand issue, in particular in China.
Yeah, in particular. And I mean, it's interesting to look at this because Tesla clearly needed to make a move. There was some reporting here from Josh Schaefer earlier today saying that Future Fund Managing Director Gary Black saying that these cuts were necessary in order to prevent further market share loss for Tesla in China. We know a lot of those Chinese EV makers certainly accounting for much of the market, massive competitors there for Tesla, something that could really stifle their growth in the region in the coming years. And we saw that reflected in some of those stocks today. You're talking about that demand issue with if Tesla and the fact that it is cutting its prices, what that means for some of these other Chinese EV makers that haven't made those adjustments yet. If in fact sales do continue to decline, we could really see extended losses not only in Tesla, but also for some of those U.S. listed Chinese stocks over there.
A couple of real surprises there when you talk about, so prices generally speaking, are 40% less in China on these Tesla models than they are here. That is a remarkable concession for Elon Musk. But the stock being up is a little strange twist that I don't think most investors expected. A lot over there that watch this space say Tesla has for months needed a lower price version, somewhere around the 25K mark, to really be competitive in China. And they just refuse to come out with that additional lower priced model. I guess this is how they get there.
Yeah, and even with this cut, though, still putting it above that level, which makes it hard to compete with some of those other players over there. Well, let's talk about EV adoption here in the U.S. because Citi is out with a new note talking about people considering purchasing an EV in the new year. And get this, 65% of new car owners, they say, are considering an EV purchase. That would be up 6% from last year, much higher than what I was anticipating. But I think the key word here is considering. Because up to 6% from the number that they gave last year. When you take a look, that didn't exactly translate into a massive uptick of what that would reflect in EV sales.
Do you see skepticism?
Very skeptical.
Come on. There is no way that number is anywhere remotely close to being accurate. What percentage of EVs are on the road in the U.S.? 6%, and that's up from 1%. I'd be stunned if that number were half of the number on your screen right now. Look, you talk to people in Colorado, and Nebraska, and Wyoming, and Utah, and Kansas. They are not considering electric vehicles. Primarily, they must have surveyed people in California, and New York, and Chicago, and Florida, because in the middle of the country, most people are not considering EVs.
Yeah, and you can see that reflected from the map that we just had up on the board. 2/3 of total EV sales coming from just 8 states. One of them, California, and this note mentioned, which I thought was interesting, 35% of the EV sales are from California. Some of these tech layoffs, that could actually have an impact on sales this coming year. We'll see.
Deloitte's out with a new survey that said the biggest obstacle to people actually considering EVs is prices. They are $18,000 per vehicle, on average more expensive than an internal combustion engine, and that primarily will remain a huge obstacle for the years ahead. 2030 phased out in New York and California. Something better be done to bridge that gap. All right, coming up, Google and Spotify are teaming up. See what new features are on tap for Android users. Next. The biggest names in tech are in Vegas this week for CES. Yahoo Finance's Dan Howley met up with Samir Samat, Vice President of Android Ecosystem at Google. Samat addresses changing consumer expectations and what's new at Android.
One thing that's great about CES that I've always found is, the industry comes together. We get to see everything that's new. one of the things that is clear is that CES and all the devices here are reacting to changing consumer expectations. And that's really what our discussion here in our Android space is all about. And that is all the devices in your life. And the average US consumer now has over 25 connected devices. All of those devices working better together. And we really think that Android is a leader in that. We've always had an open ecosystem, and that's meant partnership with the industry and bringing those devices together and making sure that you can get what you need done across all of them. So, we had some pretty cool announcements here. First, there's some things we've talked about for a year or so that we've been doing to make things work better together. We have some momentum around that. So fast pair, that's how headphones and other devices connect to each other.
Discussed at Google I/O, right?
That's right.
Yep.
We announced that there's over 300 types of headphones that now have adopted fast pair, which is pretty cool.
It's not bad.
I asked the team, how many fast pairings went on last year? Like, just give me the number. And it was 320 million. So that's pretty cool. To see that consumers are doing that. Cast is now supported by over 3,000 apps, which is pretty neat. And then on top of that, nearby share, which is the way that you and I can take our Android devices and share a file, like a picture or a document with each other, is now rolled out on over 3 billion devices. So those are pretty cool things from a momentum standpoint about how the Android ecosystem is coming together. But we also had some new features that we announced. One of them was all about our media controller. And it's just a small example of how we're trying to make it really easy for you to move media and audio between all the different connected devices in your life. So with that new media controller, you can easily move to any device that supports Cast or any Bluetooth connected device as well. And we're doing this with YouTube and YouTube Music. One of the things I'm super excited about is our partnership with Spotify. And we announced that partnership last year, a very deep technical collaboration where we can innovate together on the Android platform. And one of the things we've been working on together is getting that media controller to support Spotify Connect. So if you've got devices that you've connected with Spotify Connect, really soon you'll be able to use the media controller to basically put your media and seamlessly switch between all those things, which is super exciting and cool.
So if I have something in my bedroom, I have a speaker in my kitchen, I can say, all right, I want to bounce between the bedroom and the kitchen. Maybe I want to listen to some, metal while I cook. I don't know why. And then
why not?
Metal while I clean the bedroom. Just a lot of metal or pop punk or something. I can just easily bounce between those.
That's right. So if you come home from work and you're driving in your car and you're listening to your metal or whatever tunes you're interested in,
or
whatever floats your boat. You want to walk into the house and you want to continue rocking out, and so it should be really easy to move that to your living room, to your kitchen, and maybe when someone tells you to knock it off and it's too loud, switch it to your earbuds and continue. The media controller makes it super simple to do that now, with all the connectivity that we've built in, support from Cast and all of that. So it's really easy. And that's just a good example of how all the devices in the Android ecosystem come together.
And we have obviously some autos behind us. Where is Android slotting in there? I know we already have Android Auto. What's going on in that respect?
Well, I think there's a real fundamental change in consumer expectation right now. And what's happening is that, the phone is the center, but we're all expecting the phone to be able to be useful throughout your day, through all the devices that you connect with. And that's really what I think fundamentally we're here talking about at CES. And that's no different than with your car. Your car you now expect to be fully connected. You expect your phone to be able to be your key. You expect your media to transfer seamlessly. And so we're working with manufacturers to make all of that happen. And I think they're just responding to what we're all responding to, which is the changing consumer. I have young kids, and to be honest, if the screen that they're looking at, if you touch it and it doesn't work as a touch screen, they're like, this is broken.
Oh yeah.
And if you talk to a device and it doesn't respond back to you, they're like, what's wrong with this thing?
My nephew is constantly saying, hey Google, and then play the Spider-Man theme song. So I get it.
Right.
I totally get it.
So I think that's what we're working on with not just the auto manufacturers, but also the TV industry and more.
Awesome. Samir, thank you so much for joining us here at CES 2023. We really appreciate it.
I really appreciate it.
All right, well, coming up, we are counting down to the closing bell on Wall Street. You're looking at stocks rallying here with the Nasdaq up just about 2.5%. We'll be right back.
All right, just minutes away from the closing bell for the week. Inez Ferre here to break down the market action. Hi, Inez.
Hey, Dave, and a big rally today after that jobs report, and we are going to end the session near the highs of the session today, and we are going to end the week in green territory. Remember that this was a shortened week, so I'm going to pull up a 4-day chart so you can see. The Dow right now at 683 points higher. This is the Dow for the last 4 days. The Nasdaq is going to also end the week in positive territory, as well as the S&P 500 big gains that we saw today. The U.S. dollar index, that ticked lower this morning after that jobs report. In fact, it was at 105.6. It's at 103.89. The sectors are all in the green right now. All 30 Dow components are also in the green, all 30 right now. And the big winner for the week is the Chinese ADRs, because I'm going to pull up a 4-day chart. You can see over the last 4 days, these Chinese ADRs saw big gains. Over on the Nasdaq 100, this is a 4-day chart, so you can see where the week's going to end. But for the day, quite a bit of green is what we're seeing. Here's the closing bell at the New York Stock Exchange.
All right, well, that caps off what it was certainly a day of gains. All three of the major averages rallying here into the close. You're looking at the Nasdaq up just about 2.5%, so just off the highs of the day. S&P up well over 2%, as well as the Dow. The Dow looks like it's going to shake out just below 700-point gain at 699 points. Certainly the excitement over the fact that maybe inflation is starting to cool that really drove the action this afternoon. Let's talk about all this, what it means for the market going forward. We want to bring in Gina Bolvin Wealth Management Group President. Gina, it's great to see you here. So it looks like the markets were encouraged by this report. A bit of an overreaction, or do you think it's warranted?
Well, I think it's warranted. I think we're finally starting to see the rate hikes take effect. We know that this takes 6 to 9 months, and we're starting to see that. The jobs report today had a little bit of something for everybody. I wasn't surprised by the upside surprise. We thought that the number would come in over 200,000 because the labor market has been tight. I think what the market really liked today is that wage growth is slow. And that's good news for people in the market that are looking for inflation to come down and for rate hikes to pause.
Some Fed speak, including Raphael Bostic, indicated the Fed really didn't budge. Are the markets not listening to what the Fed has said repeatedly?
I think you're spot on. I mean, I listened to some of his comments, and it is true that the market doesn't believe what the Fed is saying. And, you can't blame the market. The Fed said inflation was transitory. It wasn't transitory. And so the market is a forward-looking mechanism. And the market believes, as do I, that we could pull off a soft landing, and it could end up being a good year, but it's just going to take the whole year to get there.
Well, Gina, speaking that's going to take the whole year to get there, what do you think the level is going to look like on the S&P when we do get to the end of the year?
I think by the end of the year, our base case is we could potentially be up 12 or even 15%. And there's really a lot of reasons why. Stocks have historically done extremely well after midterms. On average, they're up about 14% after a midterm year. Stocks have done extremely well after double-digit declines, and they're generally up around 12%. A year later. But here's a really interesting stat, right? In 94 years, the economy has never entered a recession after the midterms. So there's a lot of history that we can lean on that gives us some bullish signals. And one of them also is that, earnings have already been revised downward so much that any bit of good news could be the catalyst to get us to an up year.
You say divided government is strong for stocks. This is divided unlike we've ever seen. This is a Shakespearean tragedy playing out on the House floor. Look, I understand that, as you say, gridlock takes on extremes, but the extremes are in control. They are driving this car. Could this really be good?
Well, it's good because when we say divided government is good, we're going to see one of the reasons we like the banking sector is because the regulations might be a little bit less. But it is good because when you have divided government, neither party gets their extreme agenda. There's not a lot of big change.
That we can look forward to. Probably nothing getting done. Gina Bolvin, good to have you. Thanks so much. All right, digging into the December jobs report, we're looking at the manufacturing sector now. Employment is little changed in the industry with only 8,000 jobs added last month. In 2022, there was an average of 32,000 jobs added in manufacturing each month. That's up 2,000 jobs a month on average from 21. With us now is Jay Timmons, CEO and President of the National Association of Manufacturers. Jay, always good to have you, sir. So what do you make of today's manufacturing number?
Well, frankly, it's not that big of a surprise. I think what we're seeing is we're seeing some uncertainty. One of the big findings in our survey for the last quarter was that we've seen about 2/3 of our manufacturers now saying they see a recession at hand this year. Fed policy, as you just heard, obviously will have a big impact there. But one of the big issues that we have in the sector remains the fact that we have, even though we created 8,000 jobs, we have about 840,000 on average open jobs in the sector at any given time. That's the average per month over the course of the last year and a half.
So, Jay, when you take into account that 2/3 of the respondents of your members expect a recession over the coming year or so, I guess, how deep of a recession are they expecting? How are they varying their business activity or preparation here for it as a result of that?
What an excellent question. And I have some confusing response for you, because even though our manufacturers are concerned that there could be a recession coming up, they're still planning to make capital spending investments. They're still upskilling and training their workers. They feel good about the demand for their products, and they want to continue to invest in research and development. So, it's a little bit of a mixed message. I think part of the reason they're so concerned about a recession is not just the Fed, but also what Congress, frankly, failed to do, which was to extend pro-growth policies at the end of the last session, including permitting reforms. And that would, of course, allow us to increase our domestic energy supply. Those are the types of things that manufacturers want to see Congress tackle. And I would also add to that, we need to tackle immigration reform, because that will be not the penultimate solution, but it will be a part of the solution for this dearth of workers that we have in our sector and in other sectors of the economy as well.
Yeah, I wanted to ask you about that. How big a concern, how challenging is the workforce today, or lack thereof?
So your last segment, you were talking about a divided government and being able to make sure that really bad things don't happen when there's a divided government. There's another part of another factor when it comes to divided government that's actually good news, and that is that you can get things done in a good way when both sides are coming to the table and compromising. Look, we all know that we have an immigration crisis. It doesn't really matter how you look at it. You can look at it from a humanitarian perspective and see literally hundreds of thousands of people, including children, that are suffering at our border, either on the other side or on this side of the border. You can look at it as a workforce crisis. We don't have enough people to do the jobs in this country. You can look at it as a border crisis where we have a porous border and we need to have some border security, like the president announced yesterday. But the fact of the matter remains is that we need additional workers in this country because we have jobs that we cannot fill with the current supply of American workers. And that doesn't look like it's going to ease anytime soon. In fact, by the year 2030, we predict in the manufacturing sector, we have data from Deloitte and the Manufacturing Institute that says we're going to have 2.1 million jobs that we can't fill if the current trends continue.
Jake, just given the fact that the GOP seems to be such a mess when you take a look at what's happening in the House right now, from the conversations that you've been having on Capitol Hill, are you confident, though, that both sides are going to be able to make some progress on things like immigration?
So I'm an eternal optimist, right? I just think that Americans eventually always get it right. It may take a little bit of time, and it's certainly taken a lot of time when it comes to immigration reform. But one of the most heartening things that I've seen in a long time was the President of the United States, the Senate Republican leader, surrounded by governors and senators of both political parties at the Brent Spence Bridge in Cincinnati, which is needed to be repaired and retooled for decades. And it's possible now because of the infrastructure package that was passed last year. So when you see that kind of a bipartisan camaraderie, I do think it's possible. Yes, the House has got some problems right now. They're going to come through it. Democracy will prevail. Right will happen. And the right thing to do is obviously to elect a speaker and be able to govern. And that will happen at some point, and the House will come together. My hope is that they use this opportunity to help bring Americans together. And I think that message is incredibly important today, the second anniversary of those horrible activities on January the 6th of 2021, the insurrection. And that's a reminder to us that how things can really go wrong. But I think we have so many more examples of what can go right when we work together. Immigration reform is one of those opportunities where I think we can do something right, not only for the country, but for the manufacturing sector.
Jay, do me a favor. Don't hold your breath on what's happening in the House, bringing this country together. They'll reconvene at 10. Some big news that affects your businesses. All businesses, quite frankly, is the FTC proposing a rule that would ban non-competes. Lena Khan says non-competes block workers from freely switching jobs, depriving them of higher wages, better working conditions, but also depriving businesses of a talent pool they need to build and compete. What do you think of that statement and the proposed rule by the FTC?
Well, look, I think that both sides of this equation have some very good points to make. But here's what I don't understand. I often find that government tends to want to get involved in things that perhaps they don't need to get involved in. And if you look at the market today, it seems to me that workers have the power right now. We have so many openings that most folks who are accepting a job can probably say, hey, I'm not going to sign this right now. And if you want me at your operation, your facility, your business, then take me for what I am. I'm going to be loyal to you, but I'm not going to throw away all of my options. So I think they have probably the upper hand here. And so I don't understand why government feels the need to get involved. But I will say, not only the FTC, but if you look at the EPA announcement today, where they're opening up the PM 2.5 rule that was set several years ago that businesses are scrambling still to try to meet, it doesn't really make sense that we're going to now reevaluate a rule, and probably, I'm sure that they're opening it up because they want to make it tougher. I don't understand why we would want to make it tougher when businesses are trying to make it work and they're investing a lot of money to make it work. And then you're going to move that goalpost again. Government should not do that. They should provide certainty. And the same can be said for the SEC and what they're trying to do with the Scope 3 emissions rule, which basically will put businesses in the position of reporting on something that they absolutely cannot gather data on. When government tries to go too far, it impedes the ability of business to compete and succeed, and it makes America lesser. So we can't afford to have the government trying to impose all these rules and regulations and then not providing that competitive tax policy that they should have done at the end of the last year, not providing permitting reform. Those are the types of things that cause manufacturers to say, well, things might not turn out very well this year. I'm optimistic that we can make some changes. We can push back on some of these rules, even if we have to do it in the courts, and we will if we have to. But government should be a partner to business instead of an adversary.
We will see what rules get pushed through this year. Jay Timmons, always great to have you. Thanks so much. Have a good weekend. Coming up, ChatGPT creator OpenAI reportedly considering a tender offer that would make it one of the most valuable startups in the U.S. We've got the details for you when we come back.
OpenAI, the creator of ChatGPT, is reportedly considering a tender offer that would value the company at $29 billion. This news has garnered significant attention in the tech industry as it reflects the growing importance and potential of artificial intelligence in today's market. OpenAI's research and development in the field of AI have earned it a reputation as a leader in the industry, and this valuation serves as a testament to the company's innovative work and potential for growth in the future. Guess who wrote that? Not me, not my producers, not Shauna, ChatGPT itself. Not bad, ChatGPT.
Not bad. Not bad. Very impressive that the technology was able to do that. The one thing I will say is that it's much more boring, to put it plain here, than what you typically write, than what humans typically write, just in terms of the emotion, the feeling that goes into writing right now, the variation. You don't necessarily see that, I don't think, reflected in that script. You read it well, though. You disagree with me.
I juiced it up a little bit, but serves as a testament. I thought it was solid. I thought it was solid B+ work.
Definitely solid, and I'll give it B+. I mean, even give it an A-. But I do think.
What about the valuation?
That valuation, $29 billion valuation, certainly a massive bet, I think, on the future of this company. When you take into account what it's done while ChatGPT, the technology here, extremely impressive. Reuters had reported last month that the company only expected to make $80 million in revenue last year in 2022. So $29 billion valuation really speaks to the potential adoption of this and what the future could look like when incorporating this type of technology.
Yeah, I'm really curious what the monetizing element of this is. I didn't pay any money to use this. My kids who have used it quite often, they aren't paying any money. We know they've talked about incorporating it in Bing as search. That's a pipe dream at best. Anybody competing with that Google space just doesn't look, quite frankly, likely at all. A lot of the students who are using it, they are not paying for it. And that is an interesting aspect to watch, because New York City public schools have now banned ChatGPT, not just among students, but among the teachers as well. Now, that doesn't mean you can't use it at home. You can only not use it when you're on their Wi-Fi or on their networks. You might be on their school-issued laptops, for example.
And speaking of schools moving to ban it, I think the big question here is how you regulate it, how you keep students from using this to cheat. And it was pretty interesting. There's actually a student from Princeton. He's a computer science student there at the university. He has built an app. It's called GPT-0. And he's saying that it can, quote, quickly and efficiently label whether an essay was written by a person or whether it was written by ChatGPT. The reason, or I guess the ability here to determine that is the variation that they use or lack thereof that's included in what ChatGPT writes. I'm just so impressed that someone has already built an app that could potentially detect this in such a short amount of time. Because remember, this was only launched, the end of November?
Yeah.
Just over a month ago.
It is moving at light speed. Impressive. We shall see where it's headed. Coming up, they're the homes we all love to look at, but few of us can actually afford. The mansions and penthouses only the wealthiest among us can buy. We'll take a look at what's in store for the luxury real estate market when we return.
The luxury home market now, according to the Wall Street Journal, 7 homes are worth $100 million or more closed last year. They were sold compared to 8 the year before. That, of course, though, is the wealthy, uber wealthy, high-end part of the market, because the luxury home market is not impervious to the changing economic landscape. Let's talk about what to expect in this space going forward. For that, we want to bring in Philip White. He's Sotheby's International Realty President and CEO. Philip, it's great to have you here. Let's talk about what you are seeing, because you're out with a new outlook in terms of what we could expect in 2023. We certainly did see a drop in 2022. Overall, looking at the real estate market, what are you expecting to see this year?
Well, thanks for having me. It's really great to be on the show. So, 2022 was somewhat of a tale of two markets. The first half of the year was strong. It tailed off in the second half. Of course, we're coming off of two incredible years, 2020 and 2021. 21 was a historic year. So, it's not unusual to, consider the fact that the market will kind of stabilize, which it did in 22. 23 remains to be seen. The forecasts really, honestly, they're all over the place, whether it's Fannie Mae, the National Association of Realtors, Goldman Sachs, they all have different projections for 23. So it's really hard to really gauge it. I think, the concern that I have and that my agents have is really inventory. Inventory levels are historically very, very low. In some of the most desirable markets, there's only a 1 month or maybe 2 month supply of inventory. That's not expected to change too much. Part of it is that many people locked in very low interest rates during the last low interest rate environment we've been in. So they hesitate to let that go and buy another property. So that's kind of a two-edged sword that we're dealing with. But at the same time, I feel good about 23. I think we're going into it, in a strong way. I think what we're seeing also is that there's a divide between the buyer and the seller. The seller is really wants the multiple bid activity in 2020 and 2021. And the buyer is, looking at the volatility in the stock market, and those kind of headwinds, and that's where we are right now.
Let's talk about the rates. 6.48 on the average 30-year fixed, down from 7.08, but still more than double, to your point, what they were a year ago. How much is the luxury market impacted by the rates we have today?
Well, Dave, the interest rates, affect everything, obviously. For the high-end buyer, the impact is more seen, from a stock market point of view, with these high interest rates, as we all know, have impacted, certainly some of the high-tech companies and have caused some portfolio declines for some of the ultra, high-end investors. So, I think that's, when their portfolio gets hit, I think that's more impactful than the interest rates, because the high-end buyer that we deal with is certainly much more capable of buying with cash. And we are seeing that. We're definitely seeing it in New York City. But we're seeing it in other markets as well. So they have that flexibility. They have a portfolio as well. So, they can sometimes borrow money against their assets, at lower rates as well.
Yeah. And Philip, the activity that you're seeing, the people that are buying, you mentioned New York City being one of those places that's still seeing some demand. Where else are people buying right now?
Well, they're still buying in Florida with, no state income taxes, just and the climate. And there's still affordability. There's affordable properties in Florida. Not everywhere, but in certainly many parts of Florida there are. So Colorado is still very strong. And I talked to our big company out there this morning, and they had a strong 22. I feel good about 23 as well. So Texas is still strong. So they're, the resort markets are still, strong. Some of them have not had as good a year as 21 for sure, but I think they've been holding up pretty well, even in light of the fact in some markets, prices, if you take Jackson Hole, Wyoming, prices have gone up in some cases 50 to 70% just during this, span of time.
And certainly have seen a huge price spike in some of those hot spots that you were just talking about. Philip White, Sotheby's International Realty President and CEO. Thanks so much. Well, coming up, a new year and a new plan. The best ways to maximize your retirement savings on the other side of the break.
All right, welcome back to Yahoo Finance Live. Millions of Americans are considering retirement as we kick off the new year, but coming up with the best strategy amid a volatile stock market and high inflation ain't easy. Retirement Planners of America Senior Retirement Planner Ken Moraif here to help us kick off our Retirement Ready series brought to you by Fidelity Investments. Good to see you, sir. So as we start this new year, whether it's short term or 10 years or more away, what's the first thing you want people to think about and to check off as they consider their retirement?
The most important thing, well, it depends on the period that you're looking at. So we look at the 5 years before you retire and the 5 years after you retire as the single most important decade of your financial life. And the reason why we say that is because no matter what you've done for the previous 20 or 30 years to get you to that point, if you experience a massive loss in the markets, it could change everything. So risk control is incredibly important in our view. So how do you do that? Well, you look at the amount of risk that it takes to accomplish your financial goals. And we have a philosophy that says you should only take as much risk as is necessary to accomplish your financial goals. So if you can get there at 4%, then that dictates a different way of investing than if you have to get there with 6% or hopefully not 8%. So risk control is the number one thing. Determine how much risk is appropriate for you and proceed accordingly.
Well, Ken, there are certainly a number of changes that people do need to consider. The Secure Act 2.0, many of these has a number of provisions, I should say, related to retirement savings. When it comes to that specifically, what are the most important things that people need to consider when they are preparing for retirement or if they're already in retirement?
So Secure Act 2.0 has basically given us some planning options with regard to when you turn It used to be 70.5. You had to take required minimum distributions. Then it became 72. Now it's 73. So you can actually grow your money within your IRAs for a longer period of time before you're required to take money out. There are some advantages in terms of being able to put more money into your 401k if you're over 50. So there are a lot of planning opportunities that they have created to help to build that retirement, to get to that point where you can retire with what we call your magic number. So taking advantage of those opportunities is a slam dunk. If you put more money into your 401k, hopefully you get a match, which is free money. You get a tax deduction potentially, which is also a subsidy. And you add all that up, and there's nothing that we can do that is better for you as a financial advisor than to, I guess, put your retirement savings on steroids and maxing them out. Very important that you do that.
And Ken, let's focus on that next 5-year window. And given the market volatility, given we've still got some rising rates and at least probably a hold throughout this remainder of the year, how do people factor that in when they're considering their retirement?
You know, when you asked me the first question, what's the first thing that should come to mind for somebody who's within that decade?
Yeah.
And that is risk control. I talked about, how you diversify your portfolio to maximize the return you get, but only given the risk that is appropriate for you. There's another component to it that I think is very important, and that is to protect what you've built. Because once you retire, or if you want to retire, that magic number that I was talking about, you need to do what you can to defend that. And so we believe that the philosophy of buy and hold is incomplete. Certainly you should buy investments. Certainly you should hold them. You should prune the tree, rebalance, make sure you have the appropriate investments. But we think there's a third component that is extremely important, maybe more so than the other two, and that is you should have a sell strategy. Now, I know that sounds crazy because you've been raised to think that you should forever buy and hold. But once you get in that decade, we think that protecting principal is very important. We have a strategy we call Invest and Protect. It told us to sell in April of last year. We've been out of all stocks and all bonds since then. And the reason why is because protecting your principal is as important as determining how much risk you should take.
All right, Ken Murray, Retirement Planners of America. Great to have you, sir. Appreciate all those tips for us.
Thank you for having me.
All right, good to have you. Shauna, what's
All right,
moving?
Dave, well, it's certainly been a hectic, chaotic first week for the markets here as we kick off 2023. A number of individual movers either posting pretty significant gains or losses. So let's get into some of these individual names. We want to kick it off with Bed Bath & Beyond, the company warning that it could file for bankruptcy. Shares sinking on that news, ending the week off just about 48% below $2, hitting a new all-time low. You can see it closing the week at $1.31 a share. Restructuring expert Drew McManigal, he joined us yesterday saying that he thinks the company could file for bankruptcy as early as this weekend. Again, you're looking at shares off 48% this week. Next up, we have big tech layoffs. That certainly has been a huge story that we've been following. Both Salesforce and Amazon announcing job cuts. Salesforce is reducing its headcount by about 10%, while Amazon plans to slash 18,000 jobs. It's the largest cut from Amazon in its history. Now, we are only a week into the new year, but the tech sector at large has already shed more than 25,000 jobs this year. Taking a look at Amazon shares for the week, holding on to gains up just about 2%. The pop today coming with the broader market rally. Salesforce, on the other hand, looking at gains of just about 6%. Let's take a look at Tesla, a huge mover to the downside, posting its biggest one-day drop in 2 years on Tuesday. Now, that massive move that you can see lower on the 5-day chart here coming after its Q4 delivery numbers disappointed the street. And that wasn't all. News today of price cuts on 2 of its models in China initially sent shares to the lowest level that we've seen since 2020, just above 105 a share before rebounding, actually closing the trading session up just about 2.5%. That wasn't, though, enough to offset the losses that we have certainly seen this week, with Tesla closing off just about 7%. Rounding it out with Silvergate, really has been a huge mover to the downside here over the last 2 days. We're looking at losses of about 44%. Now, the crypto market bank really moving to the downside following some news that it had from the fallout of the FTX collapse. It forced the bank to sell assets at a massive loss to cover more than $8 billion in withdrawals. At JP Morgan, Bank of America, both downgrading Silvergate this week. Morgan Stanley, Wells Fargo, Canaccord cutting their price targets. We also had Moody's actually downgrading Silvergate's long-term deposit rating to junk status since closing at a record back in November 2021. Taking a look at the 2-year chart, you certainly see a massive move to the downside over the past 14 months or so. You're looking at losses of just about 94%. Dave?
All right, Shauna, thank you. Here's what I'm watching next week. On Monday, we get the New York Fed's consumer inflation expectations and consumer credit data. Tuesday brings the NFIB Small Business Index. We'll also learn more about Bed Bath & Beyond's struggles when they officially release their third quarter earnings before the bell. Wednesday, we get a read on home builders when KB Homes releases its fourth quarter earnings after market close. Thursday, we get the data everyone has been watching, and certainly the Fed, the CPI report. We'll also get initial jobless claims. And then comes Friday, a huge day for earnings. We'll get some of the biggest names on Wall Street: Citi, JP Morgan, Bank of America, Wells Fargo, and BlackRock all report. We'll also get results from Delta Airlines and United Health. We'll get all those reports before the market open in a huge week ahead. Coming up, Yahoo Finance's coverage of the biggest tech event in Las Vegas continues. Our very own Ellie Garfinkel spoke with the chief scientist at the International Space Station National Laboratory, Dr. Michael Roberts, about the future of the station. That's when we come back.
Professional sports had a record year in 2022. Big tech paid leagues lavishly for media rights, with Amazon beginning its $1 billion annual partnership with the NFL, and more recently, Alphabet inking a reportedly $2 billion deal here for NFL Sunday Ticket. Now, the deal's helping really push record sales in the industry. This is all headlined by Walmart heir Rob Walton buying the Denver Broncos for $4.65 billion. But can the industry repeat in 2023? Josh Schaefer has been looking into it for us. And Josh, it's a hard act to follow. What should we expect?
Yeah, Shauna, surprisingly, the experts do think the industry will repeat and perhaps surpass that $4.65 billion number in 2023. And really, it comes down to the volume of teams for sale. So if we take a look here, you can see the Los Angeles Angels are for sale. The Washington Nationals are going to be for sale. The Washington Commanders, Manchester United. Now, those two names at the back end there would probably be what could maybe set a record when you think about Man U or the Washington Commanders. Forbes has reported that the Washington Commanders could potentially sell for maybe more than $7 billion, which would be significantly higher than that $4.65 billion number that we talked about. But I think really what it comes down to, and I thought an interesting quote that someone told me, Michael Rapcott, the founder and CEO of Sports Value Consulting, said, you know, it's not like it's crypto or an internet stock when we talk about sports. There's real value here and real earnings. And I think that that's interesting when we think about big tech's involvement, right? When we think about what Google and Apple and Amazon have done for sports this year. Amazon adding $1 billion, right, a year to that shared revenue. Now potentially Google, if that $2 billion number is accurate, adding $2 billion to that shared revenue. And so that's something that 49ers president Al Guido had pointed out to me when he said, big tech is going to be what pushes this thing forward over the next 7 years too. Think about the NBA deals coming up. If big tech likes what they see from the NFL right now, they're going to love it, and they're going to get involved in the NBA too, and those valuations sport-wide. We just saw the Suns go for $4 billion to end the year.
Oh, they'll be involved. And speaking of big tech, if you keep Jeff Bezos involved with the potential Commanders sale, you're looking at well north of $7 billion. Ted Leonsis of Monumental Sports, rumored to be the likely purchaser of the Washington Nationals, already owns the Wizards and the Capitals and the Mystics. Now, obviously, media rights are the biggest piece of the pie right now, but advertising and gambling, are they subject to some pullbacks potentially if we see a recession?
Yeah, it's going to be interesting to watch. So Guido's also the chairman and CEO over at Elevate Sports Ventures, which consults across all the sports leagues and has clients across every league and internationally too. And what he said is you might see a little bit of an ad pullback or maybe more selectiveness, right? We're going to see jersey patches in more areas this year. You're going to see helmets in more area, or helmets in the NHL, I should say. Bigger sponsors there. So really what we're seeing is there's just so much inventory now. So it's about finding clients, and maybe you're not going to see the Crypto.com deal repeat itself again.
Right.
But to add on to your Leonsis point, Dave, to finish out here, I think it's going to be interesting to see if Leonsis does buy the Nationals, because that's the other thing I talk with Guido about, is sort of the ownership group structure that we're seeing form in sports and how popular that's becoming. That would be the Wizards, the Nationals, and the Capitals, and NBC Sports Washington for Monumental Sports Entertainment.
And the WNBA team as well.
And the WNBA team, the Mystics. That's pretty much the entire city of Washington outside of the Commanders.
Yeah.
Pretty impressive.
Well, it's going to be an exciting year, it sounds like. Lots that we are going to be talking about over the next 12 months. Josh Schaefer, thanks so much. We want to get to some breaking news here. Macy's trading lower, off about 4% after hours. The retailer pre-announcing its fourth quarter sales number, saying that net sales are now expected to be at the low end to midpoint of the previously issued range of $8.16 billion to $8.4 billion. Adjusted diluted earnings per share expected to be in the previously issued range of $1.47 to $1.67. Chairman and CEO Jeff Gennette saying, quote, based on current macroeconomic indicators and our proprietary credit card data, we believe the consumer will continue to be pressured in 2023.
All right, our coverage of the Consumer Electronics Show in Las Vegas continues now, where Yahoo Finance's Ali Garfinkel had a chance to speak with the chief scientist of the International Space Station National Laboratory, Dr. Michael Roberts, about the future of the station and its partnerships with the likes of SpaceX and others.
We're here along with our partners in industry to talk about access to the International Space Station for research and technology development. NASA continues to do research in space, but the International Space Station National Laboratory offers opportunities above that. So industries large and small across the United States now have access to space to do R&D in space that benefits us here on Earth. And that's a new twist on access to space.
Well, and it sounds like it's important to you that people know that the station's open for access.
Absolutely. So, for the first time in history, we have frequent access to space through the activities of SpaceX and Cygnus, operated by Northrop Grumman, and a new player from Sierra Space coming online soon. There are lots of ways to get cargo and crew and persons up to the International Space Station and beyond. So we're looking to build that even further in the future. The International Space Station is going to be operating until 2030 or so, but that's not going to be the end of it. There will be commercial platforms operating in space, joining the space station from China, that offer access to space for people all across the world.
So I'd love to hear a little bit about what some of the benefits of doing R&D in space look like from your perspective.
Yeah. So we've all seen, I think, videos of crew members playing with water by squirting it or playing with M&Ms in the space environment. So you understand that it's fundamentally a very different environment than anything we have here on Earth. That translates into fundamental studies about the physics of objects. So we've worked with material science companies that are trying to improve turbine blades for use in spacecraft and aircraft engines. We work with companies that are seeking to improve materials for use in high-performance automotive engines. We work with engineers who work in propulsion systems that are trying to refine and increase fuel efficiency in engines. And we also work heavily with the pharmaceutical sector. So living in space for a long period of time is a lot of fun, but it also wears on your body. Our immune systems don't function as well in that space environment. Our bones and muscles start to weaken over time. So you can exploit that if you're a medical researcher and understand ways to combat that here on Earth. So a lot of the things that happen to us as we naturally age can also occur with a 6-month exposure to microgravity environment. Astronauts' immune systems don't work quite as well in space as they do here on Earth. Their bones and muscles start to weaken. So it's an opportunity for pharmaceutical companies to explore new therapeutics that can help prevent the onset of those conditions here on Earth.
And one of the interesting applications I was hearing about earlier today was tide. Astronauts, my understanding is astronauts have to work out 3 hours a day so their muscles don't atrophy and their clothes get sweaty and they can't change those clothes because you can't do laundry in space.
Yeah, one of the hidden secrets of life in space is that you get to wear a lot of the clothes over and over and over again. So it's a 5-year-old boy's dream, right? Never have to change clothes, never have to take a shower.
And you're in space.
Just kind of hang out and do stuff, right? That's all you got to do. But yeah, it's an issue. And a lot of it comes down to mass, right? In order to take a change of clothes, you're adding mass to what you have to do. It's not that big of an issue in low Earth orbit on the International Space Station, but when you start thinking about going to Moon and Mars, that mass penalty, that weight becomes an issue. So Procter & Gamble is working with NASA to refine the technologies that they can use for stain removal and cleaning clothes so that we can have a ability to clean while we're in space. It also helps Procter & Gamble in that they're looking for ways to be more energy efficient. We are now living in times of greater water scarcity than any time in the history of humanity. So understanding ways to improve our ability to clean clothes and use water more efficiently translates to important things here on Earth as well.
Well, and I'd love to hear, because you have a lot of high-profile partners, not only Procter & Gamble, but SpaceX famously is a partner of the lab. I'd love to hear a little bit about how you approach those partnerships, broadly and specifically.
Yeah, so we are the downstream benefactors of the great strides that SpaceX and other companies have made. So the ability to reuse space vehicles has completely changed where I live. I live near Kennedy Space Center in Florida. So we have now launches that go up every week or every other week. And the great thing is part of the launch comes back down every time they launch something up. That has done a tremendous amount of good for everybody in that it's driven down the cost of getting access to space. They've expanded that capability at SpaceX from simply doing logistics, launching supplies, to including humans now. So the cost of living and working in space is going to become cheaper over time and become more accessible. That's already translated into the opportunities to do experiments for science, technology, engineering, and mathematics outreach for STEM education. We have payloads that go to space that are developed and paid for entirely by middle schools and high schools now, in addition to projects that are led by students at universities. So all of that driving down cost and increasing frequency of access is good. It also enables access for companies in that they don't have to start thinking about, well, I'm going to tie up a member of my staff for 2 years and have one flight opportunity, and it's going to cost millions of dollars to do that. So as costs continue to come down, we're going to see even more entrepreneurs stepping into that realm as well.
Well, and access is really important to you, clearly. And one of the things we talked about before the camera started rolling was that you want to attract more kinds of people into this sort of work. So I'd love to hear about how you approach diversity and how the astronaut corps has evolved over time from your perspective.
Yeah. So in addition to just being a really good idea, NASA has worked very hard to increase diversity across every job within the agency. So we now have it's not just ones or twos. There are minority serving institutions which feed directly into NASA that have developed flight directors at Houston that offer new advantages for students to get into the astronaut corps. And we work at that at a more fundamental level at International Space Station National Lab, in that we understand we lose a lot of diversity in elementary school. A lot of kids are turned off from science, technology, engineering, and mathematics courses because they think they're not for them. So we have, as part of our portfolio, a very active engagement to develop education programs that leverage access to station, International Space Station, because it's very exciting in the mind of a child to think about, well, I can live and work in space sometime, or I can design an experiment that goes up into space.
All right, well, coming up, there's some good news here for fans of Netflix's Wednesday. We're going to tell you what it is when we come back.
Hit Netflix show Wednesday has been renewed for a second season. No surprise, the series centers around the Addams family's daughter Wednesday and captures her time at the supernatural Nevermore Academy. Wednesday has been a huge hit for Netflix. The show ranks second all time in the streamer's top 10 most popular TV shows based on hours viewed. That's just behind the most recent season of Stranger Things, which has been a monster. This show really striking a chord with people, young people who just don't normally fit the mold, and older people that didn't, necessarily fit in. It's a little bit different than the Growing Pains or Cosby Show that we grew up on.
Yeah, certainly a number of people really tuning in and loving that show so far. All right, well, we want to get to big reveals at this year's CES. We've been doing a couple roundups, and we wanted to bring you some more gadgets that have been catching our eye. We're going to start with the new product, Fluent Pet Connect, that lets your pet communicate with you. So you're probably wondering how exactly this works. Here's a video that went viral from Bunny the talking dog.
Use your other words. I'm gonna go outside. Okay. Use your other words.
You can see Bunny the talking dog communicating there with you. The updated version is that you actually get a text from your dog with their demands. They're taking pre-orders right now. Starter pack goes for $159. Dave, this is pretty amazing. I'm not a dog owner. You are. I think it sounds pretty convenient.
If it's legit.
It could also be a recipe for disaster.
If it's legit, number one, I'm not sure all dogs are capable. I need to test this thing out. I'm a little skeptical. I always know what my dog's thinking. We're right here, Shauna.
Really?
When he wants food, when he wants out, it's very clear.
Well,
and I don't want a text from him. I'm a little busier than that. All
You're
right.
always on your phone, though. It could be pretty convenient.
That's true.
You don't even have to look up.
All right, we're also interested in the flying car that debuted at the conference. It's called the ASCA A5, and with a $5,000 deposit, it could be on the pre-order list. The full price tag, though, sets you back a bit more, $789,000, because it operates like a helicopter. The company is optimistic about receiving FAA clearance sometime soon, something I've always wondered about. Sounds awesome, but FAA, how crowded could our skies become? You talk about potential terrorism and things of the like. We've been talking about this since we were little kids with the Jetsons.
Yeah,
ready yet.
Yeah, we're not there. I think this timeline might be a little bit optimistic, just the fact that it could be in the air soon. The fact that it goes so fast and you would be controlling it, or it would be just so many of these potential flying cars in the space, makes me a little concerned.
I'm a little terrified.
Yeah, because if you get in a crash up there, you've got a very, very slim chance of surviving. Yeah. But I don't know. We'll see. All right, we also wanted to bring another update here, another gadget that was revealed. The Recharge Cabin, basically an elevated nap pod. The company is describing it as a high-tech cabin that brings you in a deep, meditative state. It sounds very relaxing.
It doesn't look it.
20 minutes. And it sounds like it's pretty effective from their marketing efforts.
Okay, water dripping on my head. I love me some nap time, but I don't need the water dripping on my head.
Maybe you'd be able to just skip that part and just meditate in that pod. All right, well, that'll do it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again Monday.
Monday.
Have a good weekend.